welcome back, everybody. SF Live episode 152 this afternoon. I'll be joined by Jonathan Mergott in a few short seconds. He's somebody I've been following quite a bit on Twitter lately. Super interesting technical analysis, gold, silver, and some of the miners as well. Really curious to pick his brain and hit on his thoughts. Gold silver ratio. Where's gold trending? Where's silver headed? And we have some questions prepared, of course. And we already received some questions from you, the audience, the listener, and the investors out there on Twitter and on YouTube. So make sure to use the opportunity as well while we're chatting with Jonathan to get your questions in. You can either use hashtag AskJonathan on Twitter or use the YouTube chat function. We are live on both channels. So make sure to do that and get that opportunity in to ask your questions, like how should you position your portfolio right now? What do you expect? What do you want to hear? Also, make sure to follow us on YouTube and on Twitter. And make sure to hit that like and subscribe button. Turn on the bell notification button as well. All our interviews are live. That way you do have an advantage as the investor when you hear and see from us. So make sure you use that advantage to your advantage. Now, without further ado, let me switch over to Jonathan. Jonathan, thanks for joining us. How are you doing?
I'm doing good. Thank you very much for having me. It's great to be here.
It's great. It feels like a world premiere. I haven't seen any other interviews. I've seen a lot of commentary on Twitter, obviously, but it's great to have you on the program. Thanks for joining us.
Very happy to be here. Thanks for having me.
It's great. Let's dive right in. And since it's the first time on SF Live, let's start with a bit of an introduction to Jonathan. Like, who are you? Your Twitter profile says portfolio president and analyst of the Meta C Mergott Foundation. So give us a bit more color. Who are you?
Yeah. So the Meta C Mergott Foundation's actually a foundation my great grandfather had started back in 1957. Interesting history. There was my great uncle Julius Mergott had started the J.E. Mergott Corporation in Newark, New Jersey. And when he passed away, my Aunt Meta had inherited it. My great Aunt Meta, who had no idea what to do with the factory in New Jersey. So she called my great grandfather. He organized the sale of the company to Fedder's Air Conditioning Company, and they formulated it into a nonprofit 501c3. And I've been managing that for, I think, 12 years now.
Wow, that's a long track record. Fantastic. Wish I had that family history in as well. I like it, like the family deals in the U.S. and how things sort of move on. And like at first I was looking, actually, I have to admit, for when I read Meta, I was looking for a financial term. I didn't expect it was a first name. So
yes, yes, it's an unusual first name. Yeah.
Run us a bit through also the focus of the foundation. What are you doing with it? Like, what's the goal? Like, you're obviously trying to generate returns for the foundation itself. Like, how are you generating those returns, and what are you doing with them?
Yeah. So it's a little bit because it was started in 1957, and at the time, I think my great grandfather had a much easier job. He invested a lot of money in CDs, making about 5 or 6%, and that was an easy day for him. Nowadays, when you got the S&P yielding about 2%, it's a little bit harder. But the goal is essentially to invest money and to, after your administrative expenses and taxes, which are typically minimal because it is a 501c3. We donate all the rest of the money to other nonprofit organizations. In the time that I've been doing this, I've really tried to focus on sick children, cancer research. We donate a lot of money to the Starlight, the Children's Foundation. Battered women's shelters, basically the people in society that are in a situation where you really need somebody to help you because you can't stand on your own 2 feet. The most vulnerable people, really, because I think and some of these small organizations are very neglected, and even just a little bit of money, they can really stretch a dollar. It's amazing to see what they can do.
And maybe we can share a couple links after our conversation as well below the Twitter video itself for a couple causes that you think are worth following as well there in your area as well. I think we should do that, right?
Oh yeah, absolutely, that'd be great.
Let's do that. And then, but also, like, besides running the foundation, you also run a financial blog, Alchemy Financial. And give us a bit of history on there. It's like, why did you start writing? And I know you've gone a bit quiet actually from 2015 to 2020. Give us a bit of a history there as well.
Yeah, it was just something I started writing some thoughts, and got picked up from time to time. Was published in a few places. Um, yeah, I mean, there's from 2015 to recently, there was just the obvious reason that it wasn't very much fun in the gold sector. There wasn't much to say. Um, so I didn't really focus all that much. As I've said before, my career, I've been raised by old school gold bugs, people that have collectively centuries of experience, and they all were primarily gold bugs that were buying and trading in the '70s bull market, buying and trading at the beginning of the early 2000s. Um, so I'm not. You could ask me what my thoughts on Amazon. Don't. It's not going to be a good answer. I typically, will invest in uh, the underlying stock market as the S&P 500 and retirement accounts as a whole, and not try and pick stocks. But the industry of gold and silver is what I know and what I've been doing for 12 years. So that's where I make my opinions. Other than that, I couldn't help you all that much. But
Yeah, let's talk about that actually, because of course, like we were more precious metals focused video blog as well, or video podcast. So it's great. That's why we invited you, because we value your views obviously on gold, silver, and precious metals and some of the miners. But you came back in 2020. Let's start with a bit of history there, or history. That's not even 12 months ago. But let's start there. Like, what brought you back? Like, you obviously saw something in the markets that prompted you to be more proactive again.
well, for starters, it was around fall of 2018. Gold and silver had really gotten slammed. That's where I started making the biggest of my core investments in some companies there, which had done very well throughout 2019, and was getting a sense that this was going to start to break higher. Everybody was looking at 1,400 on gold. Then we started breaking higher, and typical as gold is, it starts really moving, and then something really horrible happens, which is exactly what happened again this time around. We had this massive, uh, once in a century pandemic. Market crashes 30% in 4 weeks, um, which it just still like blows my mind. I remember, like my dad and my grandfather talking about how people don't know what a bear market is. You don't know what it's like in the '70s when nothing just went anywhere for a decade. They think a bear market is a crash. And they were referring to the tech bubble and 2008, which honestly was an elongated crash from about a year and a half from top to low. 4 weeks is just insane, and that's all it was. And now we're back to all-time highs. And but the volatility of it was really the thing that really got me to say, like, okay, I have to put my 2 cents in here. And people appreciate that. Got published in a few areas and passed around a lot, and I appreciate that. But that's really been kind of the premise that I've been focused on since then, for the last year, because we are not where we were 10 years ago. These moves are happening with magnitudes and speed that we have never seen before, and it's not going away. So I think that's something that people need to keep in mind. The market corrected 30% in 4 weeks. Gold dropped from 1,700 to 1,450 and back to 1,700 in 12 days. If you're long in a cash account and you're just gonna hold for the long term, not a problem. But those are the kind of moves where if you're in leverage ETFs, if you have a margin account, you can blow yourself up really quickly.
Yeah, those stops get triggered rather quickly, right? So
Yep.
and I've noticed you mentioned the comment, like it feels like things are moving much faster, and I have the feeling that COVID sort of accelerated that, because people are online more, information gets transmitted even faster, like through Twitter, like we're on Twitter, right? So I think it added a lot of pressure for me as an investor as well, trying to stay on top of everything. Like, of course I want,
Yes,
of course I
absolutely.
want to know why gold is down $10 or $20 or $30 a day. But it's tough to figure out sometimes. But I always like feel like I'm the last one to find out for some reason, right? Like, so the velocity of overall information flow has picked up an added pressure, which is really really interesting. Um, you talked about the crashes and like and let's talk a bit gold and silver here as well. So you mentioned like gold, silver dropping and rebounding rather quickly, but now we've been in a prolonged sort of downtrend for gold. We've seen a crash. Let's call it a crash early January this year as well, where gold miners, silver price, gold price dropped 10% almost within a day. Right, but let's talk about it. Let's put that in a bit of perspective because overall, in my opinion, we're still in a bull market. We're still in a very like positive environment. But let's put it into some perspective. And you predicting, for example, that silver is going to be outperforming gold in the next future or in the next 6 months. Like, what do you base that on? Let's put that all in a bit of perspective.
So a lot of things, and first of all, it's just the fact that we haven't seen silver sustain $20 an ounce or higher for any length of period of time in the past. In 2016, we had a killer rally off of the lows in miners and in gold and silver. Silver hit 21. It lasted 1 month, and then we fell back down. I think after silver had crashed in 1980, it was like 1981. We popped back up to about $20 an ounce, and we couldn't sustain that, and then fell back down. In 2008, we hit $20 an ounce and then fell back down. Every time it's traded above $20 an ounce, it's gone to 50. And we have been sustainably above $20 an ounce in a very tight range that has outperformed gold significantly. And yeah, on that note, so I was going down memory lane. I posted something about this about a month and a half ago. I'm going to try and find it and I'll repost it on Twitter. But I found it interesting. I think there's a lot of things that are going to rhyme kind of with the 2010 to 2011 area coming forward in the next 6 or so months. So I think it was November of 2010. I don't have the charts right in front of me, so this is just memory. But in November of 2010, we had hit $30 an ounce for the first time in silver on that move. It was a little short. I think we were at about 29.70. Gold at the time was 14.20. And then over the course of like late December to January, I think silver had corrected about 15% and then started building back up. So then February, we hit $30 again. But at this point, gold is now 13.80. So it had fallen a little bit, down about like 3% or so from where it was. Silver starts breaking out of 30, goes to about 36. Gold manages to climb back to where it was in November at about 14.20. It's still kind of being topped out in that range, but silver's up another 20% from there from its high. Silver goes up to about 40. Shortly later, gold inches up $20 to 14.40. Finally, at the last minute of the rally, while silver moonshots up another 25% to $50 an ounce, gold finally decides to join in and jumps about 10% from, I think it was 14.40 to about 15.80, 15.90. So now when we look at what's been going on recently, we see we hit 2,100 in gold in August and 30 on silver. We had a really quick crash that brought silver down to 22 in September. And gold, I believe, bottomed at about 1870 at the time. So then fast forward to about 3 months later or so to November 30th. Silver double bottoms at 22 again. Gold drops another like $100 from its previous low to 1760, 1770 area. Now we just had, just earlier this month, I think it was about November 5th or so, or March 5th or so, I'm sorry. Gold drops another like $80 from that previous low to about 1680. Silver makes a low at about 25, significantly higher than the two lows it had made before. So I'm seeing kind of a similar pattern here. And my expectation is that over the course of the next few months, what we're probably going to see is that from where we stand now, it would not take that much to get silver to start breaking out above 30. And I would expect that to happen probably about, I think gold would still be struggling around the 1850 to 1900 level by the time that happens. So I'm thinking we're going to have some frustration in gold while silver and silver miners just go absolutely berserk. And the GDX could maybe get back to its old high and pop a little bit higher while you're seeing 100 to 150% on some of the major silver mining companies.
Well, I want to drill down on that a little further, because like, what do you base that? Let's call it an assumption on that silver's going to drastically outperform gold? Is it just the technical analysis, or do you also see some fundamental changes in silver? Like we've seen the silver squeeze. Is that part of the fundamental change in terms of mentality? Is that why it's going to be outperforming more than gold?
That's part of it. Number one, the entire system we have is just not at all based on supply and demand. And it hasn't had to be, so why should it be? Nobody's actually taking delivery on anything. It's just everyone wants to just take a paper contract and trade it in for more dollars than they started off with. And at the end of the day, when actual physical becomes an issue, then we're going to see a bit of a decoupling here. And there is a huge industrial demand for silver, so that's part of the argument. We're seeing constantly, and this hasn't been a moment in time. It's been ongoing now for a while of actually, quite frankly, a year. When you're looking at the investment demand for gold and silver and the premiums that dealers are charging just being insane. You can't buy Eagles for less than $35 right now. Even though spot price might be at 25, there's just no silver to be had. And it's the same thing with gold. I've heard people, I think back in December, a friend of mine was trying to buy a large amount of buffaloes. And he said Kitco had like a whopping $400,000. That was it.
That's nothing on
would not
gold,
take very much for a fairly a fairly wealthy person to say, you know what, I want to diversify 10% into physical gold, and they clean out Kitco.
Yeah,
that's it.
Well, it's like, and I'm sure you heard that as well, but I heard that Perth Mint is pretty much empty and it's been wiped out, and they can't deliver anything right now, and they don't have any timelines. Do you have, like, how does that fit in the narrative?
It fits in, I think, exactly with what the whole silver squeeze kind of movement has been about. There is no physical, and more importantly, I remember back at a family friend of ours when gold was like $300 an ounce. My dad was buying every single gold eagle and Krugerrand he can get his hands on, and a family friend, he was saying, "Oh, it's going to $1,000 an ounce, $1,000 an ounce." And a family friend was like, who the heck is going to buy gold at $1,000 an ounce? And his answer was central banks, which I think was a good answer. But interestingly, now here we are, we saw gold hit $2,100 an ounce. And this is now 20 years later from then. We've had two massive recessions and crises since then, in which the middle class have just continuously taken another leg down. They get eaten alive by inflation that the Fed says isn't there. Anyone that's tried to look for a job, before the financial crisis, there was, that senior position paying this amount of money. And then you look again, and now it's a junior position with the same responsibilities, but it's paying 20% less. It's like everybody just kind of takes a level down. And I don't know how the average American, if they're lucky enough to have any money at the end of their paycheck left over instead of having debt, It's a good question now. Who is going to buy gold at 17, 18, $1,900 an ounce, $2,000 an ounce? But at $25 an ounce, silver is very obtainable.
Well, we've seen central banks come in Poland, I think, and I think it was Turkey, and correct me if I'm wrong, each saying we're going to start buying some more gold. I think Poland wants to add 100 tons to their inventory. So maybe it is the central banks, maybe back to that, right? So
yeah, it's interesting how they do that. I'm reminded of when, I think, was it Ron Paul asking Ben Bernanke like 10 years ago in a congressional thing. He said, why do central banks hold gold? And he said, tradition. Well, okay. But also, why don't they hold oil? Why don't they hold wheat? Why don't they hold copper? There's only one commodity that they own, and it's not a commodity at all. And that's the biggest misconception there, because they don't hold commodities. Central banks, they hold currencies and they hold gold. So what does that tell you about gold?
Well, it'd be interesting if once they start buying Bitcoin just to put on the Fed balance sheet. That'd be really interesting. But we're getting off track there. I actually want to nail you down on something. I heard you say $50 silver and 1950 gold. All right, are those your price forecasts to the end of the year? I want to nail you down there a little bit.
So between now and the end of the year, I'm looking at $50 silver. That's the obvious magnet that I think everybody's looking at. It's almost cliche to say 50, but I'm going to give that a big range. And the reason why is because I'm sure that on the one hand of things, there are people that are looking at 10 years ago and going, I'm not going to miss it this time. So we could see a lot of selling start coming before we hit 50. So maybe around like 44, we start having some issues. But on the other side of things, like I've said, regarding volatility and this world of just algorithms making up 90% of the trading on the market, it could go crazy. We could overshoot up to 57, 58. So the obvious magnet is around 50 there. I think a little higher for gold, but I was originally thinking closer to 24, 25. I'm revising that down to 23 because of what I was saying. I do think we're going to spend a lot of time kind of making up the ground back to the August high while silver just takes off. And so we probably could see something that rhymes with 2011, where it takes us a lot of time to get back to 2100, and then we have a 10% pop right at the end as silver's just kind of going parabolically higher. Okay. So that's what I'm looking at right now. I think there's a good chance that gold is going to be a lot more frustrating of an investment than silver is going to be.
Yeah, there's more hype behind silver, that's for sure. And with the whole silver squeeze movement, I honestly got quite excited about it as well. It was a nice injection of enthusiasm in the market that we were missing for a while.
Well, just look at how it trades. When silver goes, it's lightning.
Yeah,
it's absolutely just, as Jim Sinclair used to say, it'll light your hair on fire.
No, that's true. That is very true. Let's talk about how you're playing that, that sentiment as well. So you're obviously expecting higher prices for the commodities themselves. So how are you positioned with your foundation? How are you playing it? Are you playing it via the physical? Are you playing it via ETFs? Or do you own single stocks?
Individual stocks mostly. Right now we're positioned pretty much exactly 50-50 gold and silver. It's a nonprofit foundation. I'm not taking very, very aggressive bets by any stretch of the imagination. Our biggest holdings are Newmont, Royal Gold, Franco-Nevada, Wheaton Precious Metals, and First Majestic. So it's a little bit. First Majestic actually is the biggest holding, but I'm rounding it out a lot with the royalty companies. They did very, very well in the bear market versus the miners. But then again, for the reason that the miners have done so poorly over the last actually many decades, really, I think is the reason why they're going to outperform here. The margins that they're making here are while nobody's been paying attention, they've lowered costs. Even right now at these prices, I don't think Newmont Mining has made more money on average for every gold ounce sold than ever before. When we were at $1,900 an ounce in 2011, I think their average costs were around $1,300. So now that they're around 1,000, they're making $700 an ounce even right now. This is why they were able to raise the dividend, and they've been doing very, very well. The rest of our positions are a lot less concentrated, kind of spread out between smaller gold and silver companies. But we're splitting it pretty much right down the middle on gold and silver. We're looking for the dividends and the Newmonts and stuff like that, obviously, because of what we do. We're also expecting silver to outperform. So kind of trying to spread that around there. There's not as many dividends in the silver industry.
So if you had to take your hat off, let's take the foundation hat off for a second. Where would you put your money? Do you have one favorite stock? Let's say you said Newmont, of course, because of the dividend. It's quite attractive for a foundation. It's low as low risk as a miner gets, right? But if you weren't wearing your hat, where would you put your money?
Personally, my biggest holding is also First Majestic. I really like the company. I think they're posed to make one of the best. I think they'll probably be equal with some of the majors. I also have significant positions in Hecla, Coeur d'Alene, Fortuna, Endeavor, Pan American as well. But I think some of these smaller gold and silver companies are going to just blow the water out right here. Especially looking at we've had such a deficit in exploration for like 30 years. Nobody's put any money into this. So you start seeing these companies like Abra Plata or Abra Silver now, Go Gold, that are putting out these drill reports that are just absolutely amazing. These are going to be mines at a time when nobody has really been caring about mines. But the other thing to keep in mind, and this was the first thing I noticed after the Barrick Randgold and the Newmont Goldcorp deal, is that they increased their production in those deals more than their reserves. So they're depleting what they have at a faster rate now because of those deals. When you think about the amount of time it takes to actually put holes in the ground, develop a mine, get all the paperwork and the things that you need to actually build this, the millions of dollars it costs for development, it's like the old saying, the best place to go shopping for a new gold mine is on Wall Street.
Probably good. That's probably very true. Let's get over to some questions. We're going to open that up. You can use the YouTube chat or the Twitter function here with the hashtag AskJonathan. And we got a couple questions. Like one is from the CB Commodity Bull on Twitter. And it will be a pleasure to listen to your interview. And my question is, given that ending extension of the SLR rule is very likely to drain liquidity, reduce leverage on margin accounts, and be risk asset bearish, how do you anticipate gold reaction it will be in the short term?
In the short term,
May I ask what the SLR rule is first?
That was the rule. They just talked about it on Friday. Powell said they weren't going to extend. I forget what the actual acronym is, but it was special leverage ratios. Okay. Was that it?
Maybe. Okay, I'll have to look it up, to be honest. So,
it's for the banks regarding it was what they put into place for COVID, just to kind of give them a little bit of room. I mean, first of all, I got to imagine that while that might have been news to us when it came out on Friday.
Ratio, by the way, sorry for jumping in there. Supplementary leverage. Supplementary leverage ratio.
Supplementary leverage ratio. Okay. Yeah, while that might have seemed news to us on Friday when it came out, I got to imagine that anybody who needed to know already knew. The market didn't react all that much there. It's hard to say. There's a lot of stuff going on in the markets right now that could cause massive fluctuations. At this point in time, when you look at margin debt, when you look at some of these, like, YOLO GameStop and stuff stocks and the way they're going, and then the immediate reactions that the S&P and the entire market have after GameStop's up 30% in a day. And you think to yourself, like, wow, guys really are over leveraged. Like, if this is really like causing a problem, you pretty much have to approach the market from the standpoint that, like, on any given day that you wake up, we could have a 10% hit on the S&P. It's happened. I think we've had just since from about 2009 until about 2018, there was a few instances. You had the fat finger in, I think, 2010, everybody freaked out about, and then there was a couple other sell-offs. But from January of 2018 until now, there's been like 6 or 7 massive, more than 10% sell-offs. You kind of just got to approach it at any given point in time. Like, this is always a risk.
No,
for no reason that you might not even see coming until it's already hitting your portfolio. Yeah. So I'm not sure particularly what to say there. We'll see. I think Goldman said something on Friday about, like, well, this does, cause a little bit of caution. There wasn't any grand market reaction there, so I'm not sure what to say there. I think we just got to wait and see.
I think you put a great article at the early January out as well, when the market was correct about 10%, sort of, I wouldn't say advising, but suggesting certain strategies on how to be careful in the market, how not to overextend, not go short long. Calls that are short-term focused.
Short-term, yeah.
Not short long. That's a contradictory thing, but I think that reposting that article has a lot of good, smart ideas in there as well. So,
oh, thank you. Yeah, it really is just this is just the cost of doing business. You can't get a nice 3-4% yield doing anything anymore. So you got the choice of putting your money under the mattress and getting eaten alive by inflation that is surely going to come, even if they don't admit it, or you can be in the market, and the problem is there's hazards on the field, and that is that at any given point in time the market could go down 10% and take everything with it while everybody gets margin calls and everybody's trying to raise cash, and it's not a long-term thing. Like I said, in last year, gold went from 1,700 to 1,450 to 1,712 days. If you weren't leveraged, if you didn't have any margin, you turn off your computer screen, you walk away for 12 days and nothing changed. But that's the point. Also, if you don't have margin, and you want to be a little aggressive, you can use it when gold's at, or when things are tanking 30%. But if you're already margined and you're having trouble sleeping at night, you don't have that option. So keep those things in mind. If you're losing trouble, if you're losing sleep at night, you're probably in too much in one thing or the other, in one asset or the other, or you're spending money that you're worried about, you might need to use in the near future for an expense, and you shouldn't have it invested to begin with. So just some things to keep in mind there. Yeah.
Yeah. I hope you have a couple more minutes, because we got some great questions here on Twitter and I want to ask them. So, so Pennywise is asking, what is your take on the absence of bigger M&A deals right now?
That's a good question.
What is missing from the sector, maybe? Yeah.
There's some companies out there that I think are logical targets. Quite frankly, the number one on my list would be IM Gold. You have infrastructure, you have production, you have reserves, and it's not that much. I forget what the current market cap of IM Gold is, but it's there aren't very many companies in that situation that you could buy so cheap. Yeah, $1.5 billion. So when you look at Newmont at $50 billion. This is absolutely obtainable for them with cash or stock. I'm not sure why, because I think those would have been, especially like I said, given the fact that most of these companies, Barrick and Newmont, they increased their production and are depleting their reserves faster now since those two deals a couple of years ago than they were. So this is imperative that they have to do it, and it seems to me like the obvious move would be to buy buy the proven reserves, buy the infrastructure, buy the existing production, and just manage it better. I'm sure they've probably looked into this. Maybe they don't think they can. Maybe there's other issues there. I'm not sure, but I would imagine that's the stuff that they would go for first, and then start looking at, developing areas that they can put the infrastructure in, like, a $400 or $500 million company like GoGold that's getting the drill reports that they're doing. I'd figure that would be a little bit further down the road, but maybe they're going to go a different route about that. I'm not sure.
Okay. As a follow-up to that, actually, I think it fits quite well as a second question from Pennywise there as well. And you talked about depleting reserves. That's why I think it fits in. Is like, should miners increase their gold and silver input prices for their PEAs, PFSs? And then also, like, I'm going to extend that question, reserve calculations. Because I don't think I've seen the major miners increase their reserve pricing, making sure, like, or by increasing your reserve price, of course, you can increase the reserve you have because you can lower the cutoff, right?
So, yes. Well, I think they're probably just trying to be very conservative about that. I know Newmont, as the only gold company on the S&P 500, they're not going to get too crazy with things. They'll always kind of take a wait and see approach. As gold goes up and they have, a higher margin, they'll increase the dividend based on that price. And yeah, for the most part, I've seen things that are still around like 1,300, 1,400. So as a general rule of thumb, I think it's always better to be more conservative about that than to get things a little bit closer and then see that we have just a massive drop. Also, they're probably thinking the same thing because they've seen this before. Gold dropped in 2011. We were hanging around, 1,500, and boom, it was like $200 down within a week. Yeah. That would have screwed a lot of things up if you were estimating closer to 1,500 and then you were under.
Well, I think it's just them trying. Yeah. So sorry.
I think they're just trying to be very conservative there, but it's also something that investors need to keep in mind. Especially with some of these miners that have incredibly high costs. For instance, Harmony comes to mind. They got more gold in the ground there than you think they do. And at a certain point, it's going to increase exponentially. It's just a matter that it costs them $1,300 an ounce to pull out of the ground. But at sustainable prices above $2,000 an ounce, when they start reevaluating that at maybe about 1,700, these things are going to increase. So I'm not sure why they haven't. I think it's just them being conservative, but that doesn't mean that you can't, as an investor, if you're expecting higher gold prices, start to calculate the fact that a lot of these companies do have more reserves than they're looking at, and that probably maybe isn't why a lot of them are spending too much money on increased to do new 43-101s to prove the ounces, because they know they're there.
It's just a matter of changing the cutoff grades and raising the prices, because that's pretty much it. Yeah, fantastic, Jonathan. This was a fantastic conversation. We went way over our scheduled budgeted time.
Oh, geez,
so yeah, we're 38 minutes in. I really appreciate you.
Hey, I'm having fun.
Yeah. So it's we'll need to do this again. Maybe we'll just do a straight up Q&A question session, because I know we've got a couple more.
That would be great. Yeah, this is a lot of fun.
We got a couple more questions that we won't be getting to right now, and I apologize for that. But I really appreciate everybody sending in your questions. The point is to make this an interactive format, and I apologize for cutting in a couple times just to make this as interesting and lively as possible with some supplementary information, as we talked about the supplementary leverage ratio. So, Jonathan, really appreciate you coming on. Let's make sure to do this again soon. And then,
yes, absolutely. This was great. For the people that I'm going to look through the questions. I'll try and answer them on Twitter for the ones that I see.
Yeah, there's some also in the YouTube chat, so we'll maybe just underneath post them again as a comment if we didn't get to them. So it's much appreciated, Jonathan, as well. Everybody else, thanks for putting your questions in. This is an interactive format, so we really appreciate you joining us here. And thanks for liking our channel. Thanks for leaving a comment. Thanks for giving us a thumbs up. Make sure you turn on that notification sign as well, or that little notification bell. That way you get notified when we go live with other updates. We have one coming up very, very shortly here this afternoon, actually, as well, with a good friend out of Australia. So we're looking forward to that conversation, and you won't miss anything else. Thanks so much for joining us. And Jonathan, take Take care.